Hi, everyone. Welcome to Banyan Wealth's 2022 fourth quarter insights webinar. My name is Nicholas Sergio. I'm an accredited investment fiduciary, founder and CIO of Banyan Wealth, as well as a financial advisor and registered principal with Raymond James. This is our second webinar that we're doing, our insights webinar. We're going to try to do these about 45 days after our written piece comes out, especially now in this turbulent time. We want to be able to give our clients some insight, some updates, kind of what we're thinking, and try to help you filter out the noise and the media and the hype and the fear, anxiety that some clients are facing. So let's just jump into our 4 disciplines of investing. 4 disciplines of investing are: investing is a marathon, not a sprint. Do no harm. Knowledge creates success. Stay calm, objective, long-term oriented. Don't let fear and being scared chase you out of markets. And lastly, choose carefully what you read and to whom you listen. We know there's a lot of media hype masters out there that are really doing a disservice to a lot of investors. And we'd like you to try to ignore that and stay patient as much as possible through this period of the markets. So the Federal Reserve on November 3rd raised interest rates by 75 basis points to a range of 3.75% to 4%. This was the 4th consecutive raise of 75 basis points in 4 meetings. As you can see on this chart that goes back to prior to 2000, that every time the Fed has gone on an aggressive rate hike raising campaign, we've almost always, in fact, we have tipped into a recession. The last 3 aggressive rate cycles have led to a recession. This is one of the most aggressive in terms of time and in terms of interest rate moves that we've seen since I've been in the market since 1993. So will the Federal Reserve continue to raise and push rates higher? Well, this is a picture of FOMC chairman, I should say, Powell, shortly after he was asked a question at his press conference back in November. And he was posed with a question and kind of a statement at the same time by the Associated Press. And the question was, Chairman Powell, the stock market and bond market are reacting positively to your comments today. You know, how do you feel about that? And I found his comment, his posture to be striking. And I put it in red because Fed Chairman Powell went on immediately to say, let's be clear. Our message needs to be clear. We have a ways to go, ground to cover on interest rates before we get to a level of interest rates we think is restrictive. It is premature to discuss pausing. And that is something we are not even thinking about. This about sums up where the Fed is going with interest rates. They're in the mindset they're going to do whatever it takes to stomp out inflation. So let's take a look at some of the inflation data that's out there. CPI. The CPI report came in at 7.7%, down from a peak CPI of 9.1 June of 2022. October CPI cooled to the slowest pace since January. CPI is lower month over month from September. So let's take a look at the CPI index, and let's take from a technical point of view. You can see that CPI right here looks like it's starting to roll over. In the land of technical analysis, this looks like a rolling top. And you can see core CPI, excluding food and energy, is double topped here and looks like it's starting to roll over. So on November 10th, 2022, the NASDAQ rallied 7.4% after the CPI data came out. The S&P 500 rallied 5.5%, and the Dow Jones rallied 3.7%. Gains of over 5% in a single day are extremely rare. There's only been 22 such occurrences since 1953. Most of these occurrences of 5% more have occurred and happened during later stages of bear markets or close to market lows. 2020, March and April of 2020, 2018, fourth quarter after the Fed went on an aggressive rate hiking spree, drove the S&P down 19.7% in basically 90 days. We saw similar price action in 2000, 2009, 2008, during the great financial crisis. Again, we saw similar action. These are very rare. 2002 was another one. So this type of price action of 5+% gains on the S&P are, in the longer term, are positive. They tend to be positive for price action for markets going forward. Since the release of this CPI data, we saw a release of the leading economic index known as the LEI. I write about the LEI probably once a year. It's a leading economic indicator. And so the release of the LEI came out, and one senior director of economics or at the conference board, they're the ones who published this data, stated the US LEI fell for the 8th consecutive month, suggesting the US economy is already in a recession. So let's take a look at some of these leading indicators of inflation that the Fed is so fixated on, as well as what has contributed to large inflation numbers in 2021 and part of 2022. So mortgage rates. The national mortgage rate increased to 7.14% versus 6.7% in October. Keep in mind, at the beginning of the year, it was 3%. So your mortgage payment, if you were to buy a house, has basically doubled in interest since January 1. The chart here, the pending home sales chart right here, this measures housing signed activity. These aren't closings. This is when you go to sell your house, buyer comes in, you sign a contract, you put some money in escrow, and you go to your due diligence phase. This indicator was very weak. Month over month, home sales were down 10.2%. Year over year, home sales, signings of contracts have plunged 31%. This is a leading economic indicator. It tends to lead the actual closing of sales by 2 to 3 months. The US housing market is deflating. And I would anticipate consumers, investors, we saw some numbers today on CBC about investors pulling back and sales being down significantly in multiple areas of the country. Consumers should expect this trend to continue. Higher mortgage rates and slowing and collapsing prices is exactly what the Fed wants to do. They want to reduce the wealth effect. Will weakening housing demand permeate into other areas of the economy, slow down overall economic activity? Most likely, yes. And most likely, the housing market is already in a recession. According to another housing index, the NAHB, the US housing market is already in a recession. So let's look at auto loans, another hot topic for the Fed. Interest rates on used car loans increased to 9.6% in October. When I bought my wife's truck in August of 2021, since I couldn't get her a new truck, and believe me, she's not happy, I had to buy it off a lease. Interest rates were 5.5% for a tier 1 applicant. Now they're 9.6% for a tier 1 applicant. And if you're a subprime borrower, you're looking at 15 to 20% on an auto loan. But 9.6% is the highest auto loan rate since 2010. The average cost of a used car today is $544 per month. That's up 33% since pre-pandemic. So if anyone went out and bought a Toyota Camry or a Honda Accord in 2019, your payment was cheaper then than it is to buy a 3 or 4 year old used car today. But used cars, as we've seen in Manheim Index, are declining meaningfully. Used car market is finally showing signs of deflation, and this is a positive for inflation as well as the Fed and their interest rate policy. So another indicator, another instrument that's given the market some difficulty this year is the U.S. dollar. You can see that the U.S. dollar has been in a pretty much uptrend this year. It's pushed up about 15% this year. It's been a major headwind for equities, multinational companies, but it seemed to have stalled in this period. It had a pretty dramatic drop right here. Now, it doesn't seem much because you look at it and you think it's a stock. It's the U.S. dollar. It's not supposed to make big moves like this. The U.S. dollar experienced the 4th largest weekly decline in 50 years, just this month. That's the 4th largest weekly decline in 50 years. That, in our opinion, longer term downtrends in the US dollar are a positive for equities. They're a positive for multinational companies and a positive for commodities. Lower dollar could create a little bit of a push on commodity prices, but I'm really not that concerned with it at this point in time. In summary, a more stable dollar should be a positive for US equities, as well as a tailwind for US equities. So the midterm elections, we're going to jump onto that topic. JR and I have fielded so many questions about midterm elections. I feel like I'm running for office and JR is my vice president. I mean, we've had an onslaught of midterm election calls. So midterm elections. This is a chart provided by Raymond James. The next 12 months next 12-month returns from October 31st through the following year, midterm election years. You'll see the average return's been about 17.1%. The returns historically have been good following midterm elections, but I wouldn't overemphasize its effects. Inflation and economy remain the primary influences on the market, and restrictive monetary policy are really the main influences on markets today. I'm not going to downplay a split government is good, highly likelihood of gridlock. Markets like gridlock. Republicans hopefully will be able to dial back some future spending, thus less inflationary. Inflation and the economy are major drivers of the markets. So speaking of the markets, let's take a look at the S&P 500. This is a proprietary chart here, and it clearly shows that this is what I do on the weekends. Most people, watch football. I design charts. So you can clearly see that the S&P 500 has been on a consistent downtrend all year. And these 6 arrows represent the 6 interest rate moves by the Fed, with these last 4 being 75 basis points for a total of 300 basis points or 3%, and a 50 and a 25 right here. So you can see that the technicals here need some work. They're going to take some time. And has the market bottomed? I think it's too early to call, but we are seeing some positive divergences. We are seeing breadth and internals much, much better here than they were here. And that's a nice positive sign looking forward into markets. But we have certainly been in a bear market cycle. It is a cyclical bear market that is in a giant, large secular bull market. The average length for a bear market is 286 days. The current length is on this one is about 300 days. So we're past the average now. The average decline is about 35%. We're at 27%. Do we pull back to 35%? Again, I think it's too early to tell. So let's take a look at some headwinds and tailwinds. Headwinds, inflation still at 7.7%. Maybe inflation moderates sometime in the March, April, May timeframe. It does have a possibility to be in the high 4s, mid 4s, low 5s. We've seen the greatest wealth destruction in market history, and it looks like housing is going to follow. The Federal Reserve is still looking to move Fed funds rates to more restrictive levels. Where they end up, 5.25, I don't know. But with inflation starting to roll over, maybe it's a little bit less than the street was originally looking at. Global economies are in a recession, especially Eurozone. They've had a lot of problems with energy, Russia, Ukraine. That is a headwind. And zero COVID policy in China. China is messing up some of the supply chains. Apple iPhones, for example, iPhone 14s, and Foxconn having to shut down. Just today, we saw they had a little bit of a mini outbreak in COVID, and they were shutting some stuff down. So that is some of the headwinds that we are currently facing. Looking at tailwinds, peak CPI, June of 2022 at 9.06. I'm kind of thinking that we peaked in CPI. Inflation month over month is showing signs of easing. 50% of the CPI index is negative. We just spoke about auto loans, mortgages. There's a whole slew, used car prices, housing data. There's a whole slew of leading indicators that are showing you that inflation is rolling over. Midterm elections, as I said, are generally good for markets going forward. Seasonality, we are in the Santa Claus rally time of year into early next year. The internals are much stronger now than they were 3 months ago, 4 months ago. And we have some extreme bearishness. The AAII bullish bearish sentiment is the most bearish we've seen it. And 2022 is going to go down as the most bearish year for investors. And it's contrarian. I think that's very good. When everyone is bullish and they're high-fiving and everybody's talking about portfolios at parties and how much money they're making, it's usually a very bad sign for markets. And when nobody wants to talk about it, it's usually a very good sign. And there's been talk about Russia and Ukraine kind of coming to a conclusion in any of this war. Keep in mind, midterm elections are over. There's no political pressure to sustain this war. Europe is getting tired. Stockpiles are depleting. Russia doesn't look like it's doing so well. And it makes a lot of sense to move forward and end this war. But I'm not a politician or head of a country. That's just my opinion on that. So in essence, I think that there is a lot of media attention and a lot of anxiety out there. And what we want our clients and investors and people that are just generally on this call to understand is don't get scared out of your investments. Don't get scared through the anxiety and the constant negativity that's out there. Markets go through cycles. If you would have bought the S&P 500 the day prior to the 1987 crash, you would have annualized somewhere around 11% annual. If you would have bought it the day after the S&P, after the crash in 1987, you would have annualized somewhere in the 12% range. Markets go through cycles. Stay long-term oriented, stay calm, take care of your family, take care of your health. We're here to take care of your financial well-being. If you need some extra planning, you want to discuss proper asset allocation, give us a call. We are always here for you, but we want you to enjoy your Thanksgiving holiday with your family, enjoy the good times with company, and we appreciate your confidence. If your advisor's in the Mawa office, you can reach out to them there. If your advisor's in the Toms River office, please reach out to them over there. And if it's in the hub here, which is basically the home base, the Red Bank office, please reach out to us here. You can either email us or give us a call. And as far as social media, please check out our website. But going forward, we are going to be doing our 60 seconds with Banyan Wealth. We are going to be doing updates, timely updates, some insights, our LinkedIn page and our Facebook site. Please go on, like them, follow them. We're going to start disseminating information through those. Those are going to be our main channels to disseminate information to clients and for anyone that generally has an interest. But stay focused, stay long-term oriented. We'll get through this. Markets generally always do. And I wish everyone a happy Thanksgiving and a wonderful holiday season. From my team here at Red Bank and all our advisors, we wish the best to all of you. Thank you very much and have a wonderful holiday season. Thank you.